Speaking of the economy here, let's go to Renita Young, our senior markets correspondent, with a couple stocks that give us a little insight here. We had KB Home last night, and we've got CarMax earnings too, so we get a look at some of the higher ticket items. How about CarMax, Renita?
Well, today, CarMax shares are higher after an earnings and revenue beat, and the company's same-store sales decline actually narrowed this quarter from a quarter ago and from a year ago. So adjusted earnings came in at $1.16 a share on revenue of $7.69 billion. That was a revenue decline from year over year, but it did beat the expectation for this quarter. Same-store sales declined 11.4% versus that decline of 22.4% in the third quarter, and then the decline of 14% in the fourth quarter. Now, the retail used unit sales dropped 9.6%, and average selling prices, they dropped 5.5% year over year. And the company did purchase back 343,000 vehicles from consumers and dealers. That was a 5% drop from last year's first quarter, but it was a 31% increase sequentially from last year's fourth quarter. Now, vehicle affordability remains a challenge as consumers contend with higher interest rates, boosting up the APR of those vehicles and consumer confidence lowering. And the company has tried to help their profits by cutting costs. And this time around, it actually showed that it helped the profit. And it actually cut its SG&A expenses by about 5.7%. So it's moving the needle. It has been one of those companies to announce layoffs as well in the past, and they're just trying to be more efficient and sell more vehicles, Oliver.
Okay. Pretty good response here. Market likes it, even with the average selling price coming down, making up for it and with a little surprise. And we got an up mover in a down market this morning. How about for Ford, since we're talking cars, layoffs and seemingly still really trying to trim up costs?
They are. They're trying to trim up as much as $3 billion annually by mid-decade. And this is part of that huge effort. This time around, they are laying off U.S. salaried workers, and they did not say the amount of workers who will be impacted, but Ford said that it'll impact employees on the gas engine side of the business. Now, we know that Ford has separated the gas engine side of the business from the EV and software side of the business, and it says that that will make the company more efficient. And also some insight into that. Ford's CEO said effectively that the legacy side of the business is holding the company back as it accelerates the shift into EV. Now, the EV and software division is committed to spend $50 billion globally through 2026 to accelerate the EV shift. And the company had restructured those operations not too long ago. The two different divisions are posting their own financial results as well, so we'll see who wins. But right now, it's expected to lose $3 billion in operating profit with the electric vehicle side of the business. It's still considered a startup, so we'll see how successful or how long it takes for it to flip a profit.
Yeah, when we had the chief financial officer from Ford on earlier this year, the message was pretty clear that they do view the EV side as basically a startup where it's kind of growth at any cost, but the rest of the business is very much almost the opposite. Kind of surprised that there were still layoffs here, that they hadn't quite signaled clearly, but it does fit within generally the strategy of viewing the legacy business very differently from the new business. So we'll see how the market reads it. Thanks, Renita. Appreciate it.